On this episode of The Resilient Advisor, I have the opportunity to interview Jason Hsu, who is the Chief Investment Officer at Rayliant. We spent 20 minutes talking about the investment thesis for China, but I had some audio difficulties that traditionally I might not launch the broadcast, but I think that the content in this episode is fantastic for advisors who have not yet uncovered the opportunity that there are in China. So I apologize for the audio quality on my end. I hope you enjoy this interview with Jason. Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today is Jason Hsu of Rayliant Global Advisors. And we're going to talk about the investment thesis in China. Jason, thank you for joining us on the Resilient Advisor Show. This is your first time on the broadcast. For any of your audience that's tuning in for the first time, know that if you want to ask Jason a question, please simply type a comment on LinkedIn, Twitter, Facebook, or YouTube, and I'll be able to pose it to Jason during the broadcast. Let's start with this, Jason. Tell listeners and viewers a little bit about you and your firm.
All right. Well, thanks, Jay, for having me on the show. A little bit about Rayliant. We actually spun out a larger organization that some of the advisors may be more familiar with. We came out of research affiliates, and it was about 2016. I decided to pivot from doing fundamental indexing to China. And really, it was a comment made by my mentor and good friend, Rob Arnott, who said, to have success in your career, you got to go to where the puck will be, not where the puck is. And of course, for a big part of my career, the puck has been U.S. large cap. But I think it's probably a good bet that over the next few decades, the puck will be where China is today. And so this is all we do is 100%. Everyone on the team is skin in the game, trying to bring China beta and China alpha to the rest of the investment world.
Awesome. And that's why I was excited to have you on the show. And frankly, Jason, I hope we can turn this into a series because I agree with you. There is an opportunity in the emerging markets, particularly China for investors. And I don't feel most US-based financial advisors fully appreciate that opportunity. So let's start our question set with that. Could you please contrast the opportunity in emerging markets in China and what we have here in the US today?
Absolutely. If you think about China and US, and increasingly, we see China as sort of that rising superpower competing for spotlight. Now, some of us might want to think of this as the sort of U.S.-Russia competition, the two superpowers, and that can get uncomfortable, right? That bring us back to the Cold War. But I think the better analogy is really think of it as the rise of Japan. And during the early 80s, much of the 90s, that's actually brought greater prosperity as two super economic power go into a competition, right? Collaborating on trade on many fronts. It was more business for everyone, but also there's obviously competition as some of those businesses got into the same sector, like automotive and like electronics. And so I very much like to think of this as a redux of that. The rise of China is going to give us an uncorrelated source of growth that we probably more recently probably would not be able to get access to easily. And this increased access and this uncorrelated source of growth is just good news for everyone's portfolio.
So let's talk about that uncorrelated source of growth. And I like that terminology. So if you're a US-based financial advisor, you're building portfolios and say you buy into the thesis that you need more exposure to China. How do you think advisors who are starting the process of looking at that allocation should look to capture that return?
Well, first of all, a lot of advisors do have some China in their portfolio. Most advisors have an EM product in their portfolio, and they probably have been a little disappointed by their EM performance, right? We all know EM is supposed to grow faster. And in fact, the last 15 years, EM has grown about, 4.5% real, versus US at 2% real. But that hasn't translated into stock market performance. And that's because in emerging markets, corporate earnings growth has actually only grown at about 2% nominal, right? That's actually significantly lower than US corporate earnings growth. Now, if you take China out of EM, and China is really the long outlier here, in the last 15 years, China GDP has grown at 9.5% real, and its corporate earnings growth has grown closer to 15% nominal. So why is China this outlier? That's because you really have two parts of EM, right? You have the cyclical commodities play. So think of Brazil, think of Russia. So there's no trend line growth. There's just sort of cycles after cycles where you get some diversification from those fluctuations, but you really don't get to buy growth. And what you have with China is much more of this emergence of a young population going from unskilled to skilled, household going from quite poor to saving a lot, generating a lot of income, and consuming a lot. And this is really the opportunity for investors to take account of, which is, yes, you have some China in your EM, but it's likely that it's a underexposure still, because the rest of the EM really doesn't give you the kind of growth that you're hoping to buy with getting exposure to emerging markets. So oftentimes, we're speaking with advisors, and our suggestion is, if you really want to buy growth, perhaps carving out a separate allocation to China makes sense. So don't think of, you already have some China in your EM, because a China carve out actually is going to give you a lot more access to growth than just accessing it through EM.
Okay, so a separate allocation to China. How do you suggest advisors allocate to that? And let's use the answer to this question as an education opportunity. Could you tell us a little bit more about onshore and A shares investing in China versus an ETF that would give them some exposure that's domiciled in the US?
Got it. So I think there are two dimensions you want to look at the access question. One is onshore versus offshore, and the other one is active versus passive. So let me start with the onshore versus offshore. So another nomenclature that's been thrown around by major index providers is China A shares versus the H and the ADR. So the H and the ADRs are often referred to as the offshore China, and the A, the onshore. So let me start with the offshore. By and large, if you bought a China ETF listed in the US, and if that product has had a long track record, it's most likely it's primarily the H shares, because the H shares have been available for access for the longest time. Like, it's listed in Hong Kong. Hong Kong is a very international market. And of course, the ADRs, right? That's actually grown larger and larger over time as well. So the easy access is what people have historically bought. Now, are they China enough for you to say, well, I don't need to deal with the onshore stuff that has slightly harder access? So let me tell you about the H shares. The H shares, for historical reasons, have been almost exclusively state-owned enterprises. That's because Hong Kong for a long time was a gateway to China, was face of China. So only the biggest state-owned monsters were allowed to list in Hong Kong, projecting a facade of strength and size. So these are companies that on first day of listing is already $400 billion in market cap. They're the biggest state-owned monopolies. So if you buy the H share, you're really not buying the interesting part of China. You're not buying growth. You're just buying a lot of state-owned enterprises. And what about the US ADRs, right? You think of Alibaba, right? That's a very interesting ADR that's done well since listing, but that's actually the outlier, not the norm. In fact, what's normal for the ADRs are actually firms that don't have a good enough balance sheet income statement to gain listing onshore in China or in Hong Kong. And what a lot of advisors don't realize is the US stock exchanges have significantly lower listing requirements versus Hong Kong and China. And it's because US is much more of a buyer beware, right? There's just a very minimum listing threshold. And if someone wants to buy your stock, it's consenting adults making deals, so they don't get too involved. And so oftentimes you have a lot of low quality Chinese companies listing in the US. And that's why we tend to see a lot more of sort of these fraudulent actors which after listing blow up. And then we have many of the examples. And that's actually much more unique to the US ADRs because of the listing standard and requirements. So the onshore is really where there are a lot more stocks representing a lot more different industries, names that you've never heard of, but they're names that could possibly grow up into your next Tencent, your next Alibaba. And by and large, because it is a more retail-oriented market, it's also where larger is larger. Alpha is larger, which then takes us into my sort of next dimension for analysis, which is passive versus active. Once you recognize that, China A shares is 85% retail traded, it means it's a large reservoir for alpha, right? The chance that the other side of your trade is retail is very, very high. And this is why you want to use an active approach versus passive.
Jason, I'd like to go a little deeper on that. Could we go back for a second for some clarification? Because I'm sure for most of my audience, you laid out some information that's new to them. And I think if you're exploring investing in China, this is very important. So let me clarify my understanding. So whether you're looking at an ADR or an H share, you're not necessarily getting the China growth story that you would get versus looking at an A share onshore. Is that correct?
That is correct.
Excellent. Now, can U.S. investors and portfolio managers access A shares in the form of, or how would they access A shares here in the United States? Is probably the better question.
Now, Jay, it used to be quite difficult. You have to get approved for what's called QFII quota, but that's been changed since a few years ago. So now access is quite simple. Most managers, investors could buy directly if they set up an account with a Connect approved custodian bank. So a lot of ETFs now are starting to make available pure A shares access. And I think for advisors who are looking for more pure China access and more growth oriented China access, A shares product is where they should look.
Got it. And then you were about to go into the active versus the passive investing as it relates to China A shares. Put some context and color on that for us and how you would recommend financial advisors approach that.
Absolutely. So as I mentioned, once you made up your mind that, hey, getting access to China or getting additional access to China makes sense through A shares, the most interesting feature about the A shares market is that 85% to 95% of the trading volume on any given day is conducted by retail individuals. So not your professional hedge funds, not your investment bank prop desk. So the chance that the other side of your trade is actually someone who's not very informed, not very skilled, and is likely to lose from that trade is quite high, right? So that's the good news, right? Otherwise, in the U.S., we know it's a very institutional market. It's hard for anyone to consistently make alpha because the other side is equally intelligent and perhaps even more intelligent. So in China, the possibility for alpha is high and it's credible. And because the other side tends to be retail individuals, they tend to suffer from all of the things we teach in textbook about behavioral biases, right? They have mental accounting that's not quite correct. They have loss aversion. They don't want to sell their losers. They sell their winners way too early. They react to news that everyone already know about, thinking that it's somehow unique private information. So a behavioral finance approach tends to be significantly more successful in that market. And so certainly any sort of active strategy that targets specifically the behavioral alphas in retail markets are likely to be more reliable and more consistent in its alpha production.
Yeah, I bet the FOMO dynamic is very real over there, which can lead to bubbles, which takes me to my next question. I mean, last year was a great year for Chinese stocks. Was it a bubble? Was it driven by behavioral biases like FOMO?
Well, I think the best way to see if a bull market is driven by sort of optimism, irrational optimism, or fundamentals, is to look at whether valuation multiples have blown out, or whether the corporate earnings growth have just grown faster than expected. And very much, at least the last 1 year in China, it's been a bubble, right? It's really the growth-oriented stocks, the very expensive stocks, becoming more expensive. Last year in China, growth outperformed value by about 35%. And that's just not normal in any market under any circumstances.
1999 USA. Oh, gosh. So you feel that there is a bit of a bubble in the A shares in China?
Well, so it's really a tale of two styles. If you look at the median stock, right, you just look at what's in the benchmark index, the valuation multiple is actually at median. So it doesn't look expensive if you just look at the average stock. Where there's a lot of froth is really in the growth-oriented technology companies, so not different to the US, right? China has its own version of Tesla in near, right? It went from a near bankrupt company trading at penny stock prices to now a $100 billion company still near bankruptcy and still losing 100,000 for every car they sell. So that's where things are expensive. And you also have a lot of the value quality names, a lot of very high quality banks, a lot of very high quality consumer plays that are trading at sort of record cheap multiples. So yes, the broad market is sort of fairly priced, which is better news in the U.S., right? In the U.S., S&P is the broad average is actually expensive at 2 standard deviation versus norm. But in China, really the value stocks are at historical cheapness in absolute and relative levels.
Okay. So I cannot believe we're already 15 minutes into this, and I've got a whole sheet of questions here. So I want to be judicious. Let's talk about accounting standards in China, because the only way to really understand valuations is to have faith in the accounting that's used at the balance sheet and income statement level. So could you just address U.S. investor and advisor concerns about the accounting standards in China versus the U.S.?
All right. So there is no way to sort of make it sound better. So I'm just going to be blunt. The accounting practice in China, as everyone suspected, is fraught with manipulation. Right. So if you look at the data, you realize there's sort of abnormal number of firms that report only positive earnings. Right. Those who lose money are very, very far and few in between. Clearly not normal. But if you simply look no further, you would say, well, I have no confidence. I can't invest in China. Now, if you look deeper, what you realize is actually the overwhelming majority of that manipulation is manipulating the numbers downward. Well, that's really weird, right? Why would you manipulate accounting if you're going to make the numbers look less attractive, right? Usually you manipulate numbers upward to get a higher stock price. And this actually has to do with what I, term a very paternalistic regulatory body. So the stock exchange in China believes it's their job to make sure only good companies list. And good company means companies that don't lose money. And so they actually have rules in place where if you lose money one year, they'll come and slap you in the face. If you lose money twice, you'll get sanctions. So all sorts of sanctions are imposed on you. And if you lose money for a third year in a row, you're being prepared for delisting. And so as a result, firms are terrified of losing money. And so what they do is if they absolutely have to report a loss, they'll report an enormously large loss to build a reserve so they can smooth out next year. And if they have very strong earnings, they'll report less of it, again, storing it for future smoothing. And this is not sort of poor ethics on the part of management. It's really a regulatory rule that perhaps is a little, too interventionist and not particularly thoughtful. That's caused listed companies to have to play the game a certain way. I imagine if you have Tesla in China, that would have been delisted 4 times over.
Oh man, I really enjoyed that take, and I have a deeper understanding now of the dynamics on the accounting challenges, and I know that is one of the first things advisors bring up to me when we're talking about their portfolio construction. Another aspect that I think U.S.-based financial advisors struggle with when it comes to allocating to China is if they or their client base have a bias towards ESG type investing, where they're looking for companies that have some type of governor on what they are doing, from an environmental or social standpoint. And it's really hard to figure out what's going on in China. What are your thoughts as far as what advisors should be looking at as it relates to an ESG lens in China?
Absolutely. When applying ESG lens, not only does it reflect our value systems, oftentimes it can be return enhancing. So in China, what's particularly important is to focus on governance. This is a aspect of the company that's very undervalued in China. So if you separate firms into those that have strong governance, they have the right board structure, they have great auditing practices. There's not a zero sum between the insiders and the external shareholders. Those firms perform significantly better over time. So governance is huge in terms of just something you care about and something that really helps with portfolio performance. Other aspects, I think you just have to take a slightly different attitude. When we think about ESG, you can think about level, right? And by level, Japan and US have firms that have generally, good ESG compliance, and Europe, just a head and shoulder above everyone else. But if you want to talk about sort of slope, meaning improvement, China is actually a world-class citizen in terms of trying to get better, right? You don't expect them today to be very green, right? They're emerging, they're slightly behind in terms of putting in place technology and policies, but in terms of sort of improving where they are, they probably have been one of the better countries, and many of the firms have done more. And that's because ultimately everyone does care about higher quality air, higher quality water, policymakers, consumers, and those become pressure to encourage firms to make changes. So China's not where we want it to be today, but if you look at the improvement, many of the firms are actually quite good.
Excellent. Jason, our time is up. I really appreciate you coming on. This has been very informative for me personally. Tell me, where could viewers and listeners learn more about your company?
Well, please do come to our website. So our website is just www.rayliant, RAYLIANT.com. And from there, there'll be links to a lot of our research articles. There'll be linked to our social media and where I and my colleagues will regularly post, hopefully things that will be of interest and educational to you.
Excellent. Thanks so much for coming on, Jason.
Thank you, Jay.